Good day. My name is Bafana Mathidi. I'm the head of Equities at ALUWANI Capital Partners. 2 days ago, Finance Minister Tito Mboweni announced South Africa's 26th national budget. It was billed as the most critical in post-democracy South Africa, largely because over the last few years, as we may know, South Africa has actually been struggling to grow. So let's just break it down. What is the national budget? Quite simply, it is the difference between what you think you're going to earn as revenue, less what you think you're going to spend as expenses. And the gap, typically a deficit, meaning that you're spending more than you're earning, tends to be financed via borrowing. Now, nothing wrong with that, which is where we found ourselves over the last few years. We have been borrowing to try and meet that gap. So if you look at the numbers this year and the next 3 years, in terms of revenue, we expect to make about 1.5 trillion rand in revenue, collected largely from individuals like you and I, from personal taxes, also from VAT, which is what you spend when you buy goods and services, and then you've got other items like concessions and also customs and fees. But also the one sector that has been lagging in terms of growth and contribution to taxes has been the corporate South Africa, right? Again, a function of the way we have been from a growth point of view over the last few years. If you look at the expenses, it's the same as what has been the last few years. We've got largely education and health taking a lion's share of the expenses, and then we've got other departments also get their allocations. Now that gap between the revenue and the expenses has been steadily growing to about 7% of GDP. Now GDP, quite simply, it is the size of the economy, which is currently about 5.5 trillion, expected to grow to about 5.8 trillion over the next 3 years. The difficulty, though, is the gap has been growing, so we've been actually having to borrow more and more to finance expenditure. Why? Because the revenue has been lagging. Now, the challenge that Finance Minister Tito Mboweni had was to try and balance the books, because that trend could not go on unsustainably, which is where we start having the rating agencies starting to worry and starting to say that perhaps we need to do something drastic, otherwise we get downgraded to a junk status. Junk essentially meaning that you are unable to pay your obligations, your debt, as and when they become due, because your economy is struggling and there is no other way but to get a bailout or someone coming in, taking over your debt and essentially taking away your sovereignty, right? Which is what we wouldn't want as an outcome for South Africa. So what has Tito Mboweni done this time around? Against expectations, which we saw last year where he actually increased VAT to try and boost the revenue line. This time around, he left the revenue line completely unscathed. So he didn't go into taxes, he didn't go into VAT, but what he did was he took the knife and focused on expenses. Now, the biggest chunk of expenses goes towards salaries and wages for our civil servant. Right? We need a civil servant that is productive, that delivers services and goods to the economy. But over the last few years, though, that bill has actually been growing unsustainably, right? And therefore, something had to happen. That's the one area where he had a bit of a lever in terms of where to go and try and find the money to balance the books. But it was unexpected because in South Africa, it is very unpopular where you are seeing that kind of stance happening, largely because of the strength of the unions and labor in the economy. So he took the bulls by the horn, so to speak. He announced a 165 billion rand cut in wages for civil servants over the next 3 years. And that came across as completely unexpected and therefore most welcome by the markets. So the immediate reaction, we saw the rand strengthening just to below 15. We saw the equity markets and the bond markets actually rallying quite nicely, up about 4% on the day and the day thereafter. However, just like with a lot of budgets, it's a wish list. Right? The devil is in implementation, so the ability to actually cut that wage bill by 165 billion has become questionable. We have seen the response from Labour saying, actually, we've never had this conversation, so you can't just announce such a cut without negotiation and hopefully agreement. We've seen other sectors of the economy and also of public society actually coming up and saying, maybe this is not the best way to go. Maybe there are other avenues where we could have looked for that money. If you then look at the reaction of the markets post that, we have seen actually a complete reversal in terms of the markets. The rand has weakened to about 1564 from 1510 a few days ago. The equity market has also come back, and so has the bond market. Over and above that, the global environment has not been supportive. So we've seen the coronavirus, more infections happening outside of China than in China, which means that it is spreading, and there is no immediate response yet. And as we know, that will also impact South Africa. Why? Because China is our largest trading partner. So we have a lot of these factors that are playing against us, which therefore puts a lot of questions and credibility to the budget that has been put forward in terms of, is it practical, is it implementable, and the question remains in terms of what we'll see going forward. The next communication from the Finance Minister will be in October, where he'll table the mid-term budget statement, where he'll look back to the promises he made now in Feb, and also give us a prognosis of where things are likely to be come this time next year. And as we've seen in the prior years, the mid-term budget tends to be a lot worse than what was announced in the national budget. So the outlook, unfortunately, is not great. It's not positive, even though on paper the budget does say the right things. There is a lot of information, a lot of which is still to come. So we continue to watch what happens, both domestically and globally, largely to try and protect our clients' assets from any adverse impacts. But as we're in the cold face of this, should you have any information, should you want more in terms of what it means for you, do contact us on our social links and also on our website. But also feel free to call us or drop us an email with any specific questions around the budget, in terms of some of the detail, but also in terms of the outlook for the markets, because eventually this has a big implication for domestic market, but also for global markets. Thank you.